BDCs, there was a time when they were the bee's knee, and then they went out of favor. But now it seems like there's some cool opportunities in that little subsector as well. What is a BDC? And then tell us a little bit about the kind of the landscape for that type of private investment today.
Sure. So very simplistically, BDC is a business development corporation. And what this is a vehicle that raises permanent capital, both debt and equity, to make direct loans. Most oftentimes, I think when people discuss BDCs, in fact, I would say the majority of BDCs out there in the market do focus on that portion of the private credit market, which is corporate credit direct lending. And so you have these vehicles that can be publicly traded, or they can be non-publicly traded. And when we hear about BDCs in the news, I think most often we're hearing two things. Is one, we're hearing about valuation marks, which we can talk about later. But the second thing, I think the more relevant point that we hear about is the liquidity in these vehicles. And when you hear things like, a lot of redemption requests or investors are getting gated, what that is generally referring to is the private non-traded BDCs that only offer so much exit liquidity for investors at any given quarter. I think they're most often capped at about 5% of net assets per quarter. So if you get a redemption request of 10%, then you can gate the excess 5% and let 5% out. And that's a big difference than the publicly traded version of the BDCs, where investors can sell their shares whenever they want because there's a liquid tradable market. And the difference being publicly traded BDCs can trade below their net asset value. That's another thing that we hear a lot about today. So BDCs are trading at 20 to 25% discounts to their net asset values, and you can go sell your shares at that price. And you get liquidity, even though you'll probably be taking a loss depending on when you purchase your shares. And this contrasts to the private BDCs where you're redeemed at net asset value. So the trade-off is you have lower liquidity with the private BDCs, but if you do want to redeem, even if you get cut back in your redemption request, you're probably just going to get, you'll just get your net asset value back. It'll just take you a long time to get all of your capital back.
Yeah. So where should we be thinking about? I like the sound of that, surely. I like liquidity because that causes lots of trouble, especially when things go squirrely, and they go squirrely really quickly. So what sector or part of the BDC world are you looking at? Is it real asset type of things? Is it financials, energy? Where are you guys seeing opportunity, or where are you finding things that are interesting?
I think one of the things that I think separates one BDC from another is the management team that's managing the vehicle. This is no different than entrusting your capital with a portfolio manager to run a mutual fund or a hedge fund. You're not going to be part of those day-to-day discussions on the management of the portfolio. So you want to make sure that you're entrusting your capital to a team that can allocate that capital effectively and avoid pitfalls that we've been seeing in the market today. So today, when you hear about problems in BDCs, it's almost exclusively related to those that have excess weighting in software assets. Thanks to the rise of AI, what was once thought to be a very highly recurring revenue type of a business model with strong barriers to entry, that business model is now being upended. And a lot of these BDCs participated in providing loans to highly leveraged buyout transactions led by private equity that at 5 or 6 turns of EBITDA looked like there was a good margin of safety because you had this locked in recurring revenue, high margin, lots of cash flow, and your LTV was pretty good because even though you were lending at 6 times, if the transaction was being done at 10 times, 11, 12 times EBITDA, your LTV was really good. And so now AI has come, those business models are in question. So the multiples contract. So your 12 times asset is no longer worth 12 times. Maybe it's worth 7 times or 8 times. And if I lent at 6 turns of leverage at par, and also there's probably some cash flow impairment. Now what I thought was a 50%, 60% LTV loan is now closer to 80%, or maybe it's even close to being impaired, in which case it's not really a loan, it's just equity that hasn't been restructured yet. So that's a much different investment to make. And so when you're looking at potential opportunities in BDCs, I think it's really important to understand how diversified the portfolio is. Are you weighted towards any one sector in particular? At the same time, when the software loans were becoming more popular, more traditional hard asset type of lending was losing favor. And so even though, with a more traditional industrial oil and gas or the hard asset related loan, you might not have been getting the same high spreads that you could get from a highly levered software LBO. In a restructuring, in a downside scenario where you need to try to get your money back, you have hard assets that you can look at. When a software loan restructures, there's very little, if any, hard assets that you can look to for recovery. So when you see recoveries in software-backed loans, they're very low. And so when you're looking at opportunities in BDCs, you have to know what the portfolio is. You have to know what the manager's mandate is. You have to know what certain sector exposures that you have, and that can change the risk reward, I think, quite dramatically.
Does that mean considering a public BDC that if it's priced at a discount, it's cheap and something a value investors should look at? Or is that not the best metric to be thinking about?
Well, I think that what every value investor is going to be attracted to is seeing a big discount to NAV, oftentimes coupled with a very high dividend yield. And that's a reason to look for sure. But I think when you see those things, you ask yourself, it could be cheap for a reason. I think what we've seen two main problems looking at these opportunities. I think the first is when you think about the marks of the portfolio. So if you see a BDC that's trading at, the shares are trading at, I don't know, call it 85% or 80% of net asset value, that's baking in some margin of safety for additional write-downs in your portfolio. So if you have a very well underwritten portfolio with a very conservative valuation methodology, that's probably a discount to NAV that you can lean against. On the other hand, if you have a very aggressive underwriting culture, if you're not taking the marks on your portfolio that you really should be as performance deteriorates, that 85%, 80% discount to NAV, it might need to be 70% or 75% of NAV. It might not be enough. You might have additional portfolio deterioration that could go alongside that. The other thing that we keep in mind is that when you look at the discount to NAV of the shares, you have to keep in mind that most BDCs, in fact, I would say all BDCs, generally run with their own fund level leverage. So that's the debt part of, the BDCs raise debt and equity. And so if you're a highly levered BDC and your NAV, or if your shares are trading at a 20% discount to NAV, well, you have to layer on the par value of the debt on top of that. Because if you're highly levered, then what might look like an attractive 20 to 25% discount to NAV might in actuality really just be the difference between buying the portfolio at par or 90 cents on the dollar, depending on the specific impact of leverage there. And so, a portfolio of loans at 90 cents is a much different conversation than a portfolio of loans at 80 cents, for example. And that's all margin of safety. And so it's important to keep in mind the entire structure of the portfolio. I think that's one risk that we see. The second risk that we see that people need to keep in mind is the fee structure of BDCs. BDCs charge management fees and incentive fees, not unlike a hedge fund or a private equity firm. But what's unique about BDCs is two things. So one, the management fee gets charged on gross assets. So not just your net assets. So if I go out in the market and I raise $100 million of debt and I have $100 million of equity, the shareholders get charged a management fee on $200 million worth of assets, not just the 100 that they put in themselves. And then the second part is, because most BDCs are just par lenders, there's not a lot of room for upside capture in your debt instruments. Maybe there's a little bit of OID, but a more traditional type of a hedge fund might earn an incentive fee on capital gains. So I go out, I buy a bond at 70 cents on the dollar, it rallies and gets taken out of par. I made my coupon, I made 30 points of capture, so I get a performance fee on that. But BDCs don't really have that same dynamic. So instead, what they do is they charge an incentive fee on the interest income that the loans generate. And so if I make a SOFR plus 600 basis point spread loan, I subtract my cost of finance, the debt on my BDC, and then as long as my equity earns some hurdle rate called 6%, 7%, 8%, then I get a performance fee on that difference, which when you start adding up all those fees on just the equity, the shareholders of those BDCs aren't really providing or aren't really being charged, a 2% management fee or, blended 3% inclusive of the incentive fees. It's gonna be closer to like 4 or 5% on gross assets, which could be as much as 10% of NAV, which is all capital that could be going to your dividend. So we don't necessarily think that there's great alignment of interest between the shareholders and the actual management of BDCs. And of course, it can depend on how it's set up. This isn't to say that there's not BDCs out there that are a lot with structures that are aligned with shareholders. In fact, some BDCs, when they get into a rough patch of performance, they could suspend the incentive fee until they reach a high watermark, and that's good. But it's something to be mindful of, because the incentives of the manager could just be to keep the thing afloat and to be generating just enough income to cover their fees, as opposed to trying to maximize the return on equity.